Chinese onshore bonds are becoming a bigger part of global investors' portfolios, implying their gradual acceptance as mainstream income investment ahead of the expected official inclusion into one of the most followed international benchmark bond indicators.
Australian investors' participation in yuan-denominated Chinese onshore bonds climbed to 1.09 trillion yuan, $172.9 billion in March, up from 1.07 trillion yuan in February and from 761.6 billion yuan in March 2017, based on statistics from China Central Depository and Clearing. The rising foreigners' holdings, however, is from a very low base. Foreign possession remains only about 2% of China's $12 trillion bond market.
The country's debt had been excluded from major global bond indices because of China's restrictions on market access, capital controls and other operational issues. Bloomberg's announcement last month that it would conditionally add Chinese yuan-denominated government and policy bank securities to its global bond benchmark indices starting April 2019 was a major stamp of approval of the nation's liberalization efforts, analysts said.
The inclusion is a validation that Chinese bonds are investable and investment-worthy, said Teresa Kong, portfolio manager at Matthews Asia. It provides positive reinforcement for the steps toward liberalization that the government has undertaken.
Investment-grade Chinese bonds will be gradually phased into the Bloomberg Barclays flagship Global Aggregate Index, with 386 securities expected to be added by 2020. They will represent 5.49% of the $53.73 trillion index, the fourth largest currency component after the US dollar, euro and Japanese yen. Analysts estimate the inclusion will bring an additional $100 billion to $300 billion in foreign investor demand over the next 3 years because passive exchange-traded funds by nature will be forced to invest in line with the allocation of the global aggregate index. In recent years, Chinese authorities have taken steps to open up the nation's capital markets as it aims to promote yuan internationalization. The recent launch of yuan-denominated crude oil futures was the latest step to boost foreign demand for its currency, analysts said.
So far, nearly all of China's crude oil imports are still priced in US dollars. Should more of these imports be priced and transacted in yuan? This may significantly increase the global demand for yuan. United Overseas Bank's head of market strategy Heng Kun Hao said,
"The petrocurrency theory holds that proceeds from crude oil sales to China are recycled back into Chinese government bonds, further adding to the allure of Chinese fixed income instruments and the currency," Heng added.
However, next year's bond inclusion could be delayed if the People's Bank of China fails to resolve 3 key operational issues for foreign investors, Bloomberg said. These include the ability to allocate block trades, or purchases of a large number of securities that
are favored by global funds across their portfolios, clarification on tax collection policies, and same-day bond settlements related to the Bond Connect. Kang Xiang-ng, Asia-Pacific head of fixed income at State Street Global Advisors, also warned of common concerns that were making foreigners uncomfortable in adding corporate bonds to their portfolios, such as low liquidity, rising defaults rates for Chinese companies, insufficient transparency and financial disclosure, as well as lack of international credit ratings while domestic ratings are deemed unreliable.